Hello and welcome to the Magellan Infrastructure Quarterly Update. I'm Mark Burgess and I'm pleased to be joined by two portfolio managers for the strategy, Ben McVicar and Ofer Karliner. Welcome, guys.
Hi.
Hi.
Mate, perhaps, Ofer, if I start with you, 2025 was a very strong year for infrastructure. Last quarter, also a strong quarter. Can you perhaps talk through which stocks drove that and if there are any laggards in that result?
Sure. I'll start with UK Water. It's been a long-standing thesis of ours. These things were very cheap. We've spoken about it a number of times. We've actually seen that thesis play out in 2025. So we're a positive regulatory determination, had a benign review into the sector. And what we're seeing now, and particularly in Q4, was the results are actually demonstrating the quality of these businesses. And as a sector, the investments we have in UK Water are up sort of over 17% for the year. They had a strong final quarter as well. So again, playing out as we've expected. It's taken probably a bit longer than we would have liked, but certainly it's good to see it finally come through. Another one is Ferrovial has been a good performer, again, up very strongly this year, had a very strong quarter as well. Its traffic for its underlying toll roads, it's a Spanish-based toll road company, but most of its assets are in North America, have exceeded expectations. And we've also seen some very positive increases in its major asset, increased tolls in the 407 ETR in Toronto by between 15 and 22% for 2026 as announced toll increases. So that's quite positive. Low elasticity of demand, so we should see revenues tick up there. Star performer this year has probably been Italgas, the Italian gas distribution company. For the year, it's up 97%, bit over 97%. So very strong year, been driven by a couple of different factors. It merged with the second largest gas distribution company in Italy, TI Gas. And as they opened that door and got inside, they actually said, well, we can generate more synergies than we initially anticipated. So that's very positive. We've also seen the momentum around the threat to ESG, to the gas businesses kind of dissipate. We've always been of the view that people are pushing too hard on the gas being not part of the mix in 2050. For us, it was a net zero future, never an absolute zero future. You needed gas as part of the energy mix, particularly in cold climates. I think there's been a bit of a recognition of that over the past 12 months, not just in Italgas, but Italgas as well, and that's seen it perform particularly well. On the airport side, it's been a bit more mixed in the final quarter. For the year as a whole, traffic's been good for all the airport companies we look at, strong capacity growth particularly. But in Q4, we saw for ADP, which is the owner of the Paris airport system, was the regulator rejected their tariff increase for 2026. And that was based on a technicality, a disagreement over the way they interpret the rules. In and of itself, it's not a huge deal because they asked for 1.5% increase and ADP is going to refile, but it has implications because they've just applied for a very long-term or 8-year regulatory determination. So there's a read through there that's quite negative. So the stock performed poorly in the quarter. It's been probably the biggest lag in the quarter. I think it's certainly in the price now. We never gave them the full amount of their request, but I think it's probably in the price now as well. And more broadly, US utilities were a bit weaker in the quarter. There's some idiosyncratic factors, but just as a whole, the group was soft.
You mentioned US utilities. No doubt the impact of Trump and his attempt to block a number of offshore wind developments would have contributed to that. Ben, maybe if I turn to you, was that a factor? And if not, what other factors contributed to weaker US utilities?
Yeah, so US utilities during the quarter, as Ofer said, they were weaker performers. In fact, when we look at our portfolio, we had none in that period. In the quarter is a short period of time, we're long-term investors, but over the quarter we saw none that were positive contributors to the portfolio. And in fact, what we really saw over that period was many were down, call it 7-8% over the period. And what's driven that is a suite of issues. So one I'd call company-specific factors. So we saw companies like Eversource impacted during the period. You saw some regulatory developments there that weren't in their favour. They were trying to divest primarily an electric business, but they were trying to divest a water subsidiary. This was really intended to just right-size their balance sheet for what they've got to do. And you saw the regulator there block that transaction. We also saw another company, Excel, they're a Midwest-based utilities business. They ran into some issues when the Attorney General in Texas sued them for $1 billion in relation to a wildfire in the state a few years back. And so what we really saw there is a situation that we think that's probably somewhat of an ambit claim because that was the original total estimate, $1 billion. They've already settled with a number of property owners and landowners for 400 million. So that sort of takes a large chunk of it out. And in both instances, our view on that is that these are, call it speed bumps. We think the businesses will work their way through these, and we remain long-term investors in these companies. One of the other issues is the one you just mentioned there around the sort of Trump administration and wind. This has been an ongoing, call it issue with the Trump administration against renewables, particularly offshore wind. As a reminder, our sort of thesis on this has been that we fully expect the administration to try to push back against renewables where they have the remit to do so. It just so happens that remit is quite narrow. It's really on, call it the projects permitted on federal land, which offshore wind falls within that. So what we saw there is at the back end of the year of 2025, we saw the Trump administration effectively try to revoke the concessions, the permits there, really off the back of, in this case, call it national security grounds. This should have all been looked at previously, but notwithstanding, we've seen the administration try to do this already, and work was resumed pretty quickly after a court order. So this will work its way through the system. That impacts, again, the company Eversource I just mentioned, as well as another company, Dominion, who are a primary Atlantic Coast utility. So there's been a suite of different factors. And then the final one is probably this pure sentiment, but everybody in markets knows the AI data center trade that's been sort of going on. And I think most people who sort of follow closely have seen that some of the heat came out of that at the back end of last year, as some of the sort of euphoria started to wane a little bit. And that doesn't impact what we invest in too much. It's obviously a growth option, but it doesn't impact what we invest in too much. It particularly impacts a lot of the stuff we don't invest in, the more competitive utilities. They're much more exposed to the vagaries of that sort of power demand build out.
Yeah, right. So thinking about, you've given a snapshot, both of you, across what's happened in the last 12 months and some of the factors driving that. Maybe if we step into 2026 and look ahead, what do you view as the key sort of opportunities and also the key risks for the year?
So we've written a number of articles looking at the risk of rising electricity costs. This is related to the AI demand that's coming through data centers and increasing load growth. We're seeing some responses there in terms of changing tariff structures, etc. But in a year where you have, I think, 36 governmental elections coming up, it can become a political issue. Yeah. So we're very conscious of that and watching that quite closely. Thus far, we haven't seen any major impacts, but certainly it's something to watch for us. To extent, we do see this AI theme continue to, it could be a positive or a negative. If it continues to run, then we continue to expect bigger capex programs from our utilities. If it does deflate or pop, if there's a bubble, if you want to call it that, then again, we're not that affected. We're not going to see huge declines in revenues at all. We'll see the slight decrease in growth rates potentially. So that's really a sentiment issue which could impact the utilities in our space. The big wild card is probably geopolitics, and within that, the biggest wild card is Trump and what he chooses to do. Obviously, we've seen actions taken in Venezuela. He's talking about potential actions in Iran. Those largely don't have a huge impact on what we do. They could probably impact oil prices at the margin. Greenland is a much more interesting prospect insofar as, is it just bluster? Is he maximalist demands and will work his way back towards larger military bases and more freedom of military access to Greenland? Probably what he wants ultimately. But to the extent there's a push into military action or particularly strong arming Denmark into taking decisions they don't want to otherwise take, that could create significant tensions, and geopolitically that could be very disruptive for Europe and for the US. Something to watch there, but it'll affect everyone, not just infrastructure, obviously. And in fact, I think infrastructure will do relatively well in that environment. So we're obviously very conscious of that. Within Europe, France is still a bit of a difficult political market, so to speak. We've seen number of governments fail. The current government failed to get through a full budget, so we've run through this year effectively with the replication of last year's budget. That's a greater than 5% of GDP deficit, which is against EU rules. It's also not sustainable long term. So something has to give there. We'll probably muddle through for a year or two as possible, but ultimately the solution is probably going to be higher corporate taxes, We kind of factor that in already, but to the extent we can get some stability, that's a positive. But instability obviously is a negative, and it's not clear how that plays out in the medium term. But we'll probably kick that can down the road at least to the end of the year for now. On the positive side, certainly we see opportunities in the airport space has been really good. We've seen capacity continue to grow, as in deliveries from manufacturers pushing up. There's been a number of issues I think we've spoken about historically. Engine issues with Pratt & Whitney engines, which for Airbus in terms of deliveries for Airbus jets and taking active planes out of service to fix those engines, and Boeing having restrictions on production after a number of crashes. Those are slowly winding back. IATA's forecasting a record year of jet deliveries for 2026, and about 34% increase from 2025. So quite substantial increase in jet deliveries. We're still at a 17,000 jet backlog, about 6 years of capacity. They expect it's going to take till about 2030 to clear that backlog. So we expect continued growth and cadence of growth. Even if that you replace older jets, which are some in service, some will be replaced. Obviously, these newer planes are much more fuel efficient, which mean ticket prices come down. Ultimately, more capacity, cheaper ticket prices is good for passenger demand. So we're quite positive on that sector as well.
So you've identified a lot of macro political risks. You've identified some opportunities and some tailwinds. As an active manager, maybe Ben, I'll turn to you. What are you doing to take advantage of the opportunities and mitigate the risks in the portfolio?
Yeah, across the portfolio, we think we have a lot of opportunities. It allows us to develop a pretty diversified portfolio at this moment in time. Ofer's outlined, what is the long list of major risks that you sort of see out there as you look forward into the year and beyond. We're very conscious of these risks as we build out the portfolio, and we sort of manage that through two vectors really. One's obviously position sizing, where we see exposure, but the other one's also what we put in the portfolio and avoiding some risks that we don't want to bear altogether. But notwithstanding that, the portfolio, we continue to have a bias at the moment in terms of our weightings towards Europe, UK. As a reminder, the reason we're there is not so much a top-down thematic view, it's a bottom-up, really opportunistic view as to where we see value. And that's really how we tend to operate when we build the portfolio. The way we really view the world at the moment is, those opportunities were particularly cheap, when we sort of got into some of these a few years ago, and we still see very constructive opportunities in that space. But what is kind of interesting, we've talked a little bit today about how we've seen the US utilities, particularly as laggards. So we're sort of seeing some of that balance out a little bit more. We're seeing now probably a bit as, some growing opportunity in the North American US market at the moment. The portfolio at the moment, we remain, call it 55% of the portfolio is Europe and UK. We've got 35% in North America, and then the balance is really Australia plus a bit of cash at the moment as well. So we think that's a decent balance in the portfolio. We're seeing some interesting opportunities bubble up at the moment. Another, we touched on US utilities as being, relative underperformers at the moment, but another one is the tower companies. We're seeing that space is looking relatively attractive at the moment from a valuation perspective. The fundamentals, there are a few reasons why they're trading the way they are at the moment. A really clear example of that is the position we've got in Cellnex, which is a European business. This is a business that we've really built a position in over the course of 2025. The reason we like this business is it's the largest European telco tower provider. They have across 5 major markets over 110,000 towers. So they're a very large operation. They really built that business through acquisition. They peaked in terms of share price and that sort of acquisition spree in 2021. They were kind of in, call it repair mode for a few years after that. But where they stand today, we can really see that current management have really started to build that business towards a direction of now getting cash flow returns to shareholders, driving efficiency in the operations. And we can really see that the story there looks particularly attractive. And one of the things we like about it as well is the valuations today are just very undemanding from our perspective. And so we like that story. And we see that company plus others look kind of interesting at the moment. And then the other space that we see some interesting opportunities emerging is in that US utilities space as well.
Thanks, Ben, and thanks, Ofer, for your updates today. And thanks very much for watching. If you'd like further information around the Magellan infrastructure strategies, please visit our website.